These are 7 AI stocks super investors own right now in 2024. They're all huge market leaders who likely benefit as AI incumbents. Combined, they're worth more than $9.4 trillion. In this video, we're covering all of them in order to save the best and the biggest until the end. Starting with number 7, Dynatrace. Dynatrace is a $13.6 billion company trading just $5 above its 52-week lows. Today, there are 2 super investors who own shares of the stock, Torre Funds and Poland Capital Management. These are small positions for each of them, but they've been split. In the most recent quarter, one of them sold and one of them bought. Dynatrace allows customers to monitor and analyze their IT infrastructure, using machine learning and AI along the way. The business had a more recent entry to public markets, and since then, it's done all right, but it is down 40% from its all-time highs, which it hit back in 2021. A GF value comes in at just under $62 a share. That's $17 above today's stock price, saying it may be undervalued by as much as 24%. Analysts aren't as bullish as what the company's growth may suggest based on its fundamentals. Today, they're targeting $56 as a price with a 20% upside. It seems likely from what we've seen so far that AI is going to benefit a lot of incumbent technology businesses, but of course there are going to be others that it displaces. Still, these are the companies that have made the most progress in the field, and these are the ones that super investors are betting on. That's why we're covering them in the video. Remember, this isn't financial advice, it's an overview of their portfolio positions. Use common sense and do what's right for you. Now let's keep looking at our list with number 6, IBM. IBM might be a sleepy B2B business today, but it was really the Amazon or the Microsoft of its day. Currently, only 2 super investors own international business machines. That's Lee Ainsley and David Katz, just with minor positions in their portfolios. Warren Buffett himself had nearly 19% of his portfolio invested in the company just over a decade ago. But the company has struggled since then, and he rotated out of this position, putting the proceeds into Apple. That's been a home run. IBM is a $166 billion giant that trades $30 below its 52-week highs. IBM has done great as a stock throughout their history, but in the last 10 years, their stock price is actually down 10% overall. Maybe one shot at redemption here is that IBM is a dividend aristocrat. They've grown their dividends for each of the last 28 years in a row. In fact, I've covered the business in more depth on the channel, so be sure to look at that. Right now, however, the company pays a big 3.97% dividend yield. Overall, though, their shareholder yield comes in at 2.91%. It's hard to believe now, but IBM was one of the original innovators in the AI space with their IBM Watson. They applied Watson broadly, all the way from healthcare and meteorology to business applications. While they still tote their AI capabilities, they've been left in the dust from companies like Microsoft and Google in recent years. Yet still, IBM's trading out ahead of most of these standard methods of valuing their business. A GF value for the company today comes in at $147 per share. That's $20 lower than their current stock price. Analysts are still incredibly bullish on the business with a $210 price target. That represents a 24% upside. We'll see how this one plays out. Adobe comes in the 5th spot on our list. Adobe is a $212 billion company trading in between its 52-week high and low. Recently, their stock has been falling and they're now down $160 from their 52-week high. Adobe's owned by 7 super investors, and until recently, this used to be more, including Terry Smith, who's been called the British Warren Buffett. Notably, 5 of these 7 have been sellers of Adobe in the most recent quarter. Adobe's been taking advantage of Gen AI, especially across their Creative Cloud. And throughout its history, Adobe has had amazing stock performance. Even in the last decade alone, they've crushed the market and they're up nearly 7 times. Right now, Adobe's trading around in line with what you could expect from their free cash flows or their earnings. They are, however, trading below what their price to sales has been historically. As with these recent declines, today a GF value comes in at $579 per share. This says Adobe might be as much as 17.5% undervalued. And when we check out their dividend information, Adobe doesn't pay dividends and they never have. But the company has bought back some shares. They've repurchased just under 1% of their shares in the last year alone, so they do have a small shareholder yield. Analysts are also extremely bullish on Adobe, targeting a $618 price target, giving it more than a 30% upside. Next on our list, we have Meta Platforms at number 4. Meta, formerly known as Facebook, is another incumbent business, this time in digital and social media, that's likely going to be a big beneficiary from its AI contributions. Mark Zuckerberg may have made headlines with all of his investments into the metaverse, but much of this capital spending was actually going to power Meta's AI capabilities. Today, Meta is a more than $1.35 trillion business that's up more than 4 times from its lows, which it hit in 2022. Recently, though, the company's stock price has dropped. They had a recent earnings call at the end of April where they offered some weaker than expected guidance. Potentially in part because of this, Meta's down more than $70 from their all-time highs earlier in the month. Surprise, surprise, with its great performance in the last couple of years, Meta is the 4th most owned super investor stock. Today, 24 of them hold positions in the company. There are some huge positions in Meta from the likes of Rob Vinall, Chase Coleman, Pat Dorsey, and Carolina Panthers owner David Tepper. Big concentrated positions in this business. Meta also made headlines earlier in 2024 by announcing the company's first ever dividend. Today, this dividend comes with a pretty modest yield. Not quite what you're going to see here where it only says 50 cents. In reality, it's around $2 per share. Even with this dividend, Meta still has a slightly negative shareholder yield. Though they have been buying back some shares, the company dilutes a significant amount through stock-based compensation. Meta was originally touted as a busted IPO, and it's hard to believe the company is up more than 24 times from its lows more than a decade ago. Meta's had great historical performance, and that's why, if this can continue, and based on how the company has been valued in the past, they look pretty favorable compared to what the company is trading at today. Now, the thing to keep in mind here is really the staying power of the business. Meta can see this in itself as it disrupted a lot of the traditional media businesses. That's why it's trying so hard to stay ahead of the curve into the next generations of computing. Still today, based on the numbers, a GF value is coming in at $353 per share. That's priced 26% above Meta's current stock price. So maybe the company is overvalued. Analysts want to see Meta go even higher in its future, targeting $505 as their price target with a 14.5% upside. On our list at number 3, also the 3rd most owned super investor stock, we have Alphabet, the parent company of Google. It's owned by 26 different super investors, and that's led by the Chinese Warren Buffett, Li Lu. He has 21% of his US listed assets invested in the business. Today, Alphabet's a $1.97 trillion business that just beat on their most recent earnings, announced its first ever dividend, and announced a $70 billion share buyback authorization. Because of that, it's trading $4 off of its all-time highs, and it's up nearly double from what it was at just a couple of years ago. With their recent buybacks and that newly announced dividend, Alphabet is now giving shareholders a 3.76% shareholder yield. That's not bad for a big tech company. Alphabet is using AI pretty much across the board throughout its company. Look at the platform you're using to watch this video. YouTube is heavily influenced by AI, especially its recommendation algorithms. Not only is AI being used on YouTube, it's also being integrated into Google search results, and it has been for a long time. Basically, since the company's founding, Larry Page and Sergey Brin have set out to create an AI-powered business. This quite literally comes from the company's mission to organize the world's information and make it accessible and useful. Today, they're trying to supercharge this with deep learning and large language models. Right now, Google's valuations are toward the top end of where it would be fairly valued according to their earnings or their free cash flows. They also trade out above the range that they've been at based on their sales in the last decade. With that most recent spike in their stock price, Google today is trading a little bit higher than their fair value, roughly about 14% over their GF value of $153 per share. Yet again, analysts want to see the price of Alphabet go even higher. They have a $174 price target, projecting around a 10% upside. Number 2 on our list is one of the most famous and most popular AI companies out there. It's Nvidia. Nvidia is owned by 5 super investors, including a couple of repeats on our list, David Tepper and Chase Coleman. Decent sized positions from 4 of these 5, even though they have been trimming in their most recent quarter. Nvidia is the $2.12 trillion GPU behemoth that's tripled their stock price in the last year alone. Right now, though, they are trading $123 down from their 52-week high, which it hit just about a month ago. Even as their shares have soared higher, Nvidia does offer shareholders just a pretty small yield. Here, it comes in at 0.54%, and that's due to a 0.5% of buybacks, plus a little bit of dividends. Nvidia's kept that slight dividend payout the same since 2018. Not only is Nvidia seen as a pick and shovel play for the breakthrough in AI permeates nearly everything the business does. The company heavily uses AI in graphics applications. Their GPU chips are used by nearly all of these top AI companies. It's insane, but in the last decade, their stock price has gone from under $5 a share to its high of $950 a share just within the past month. From their low over this time, they're up more than 200 times in just 10 years. Incredible. The thing to keep in mind with Nvidia is that they're way out ahead of pretty much any normal valuation of their business. Even on the basis of revenue, they're trading at 50 times sales right now. They either need to sustain their sales for a very long time to come at a high growth rate into the future, or this one could be a pretty hyped up investment. As we've seen before and we're likely going to see again, analysts are still bullish and very rosy on Nvidia. They're targeting a $966 price target, saying Nvidia still has around a 17% upside. Now the top spot on our list, it's the company that helped kick off this recent AI craze. It's Microsoft. Microsoft, as many of you know, is a partner to OpenAI, makers of ChatGPT. Today, Microsoft is the second most owned super investor stock. 31 different super investors own the business. This includes more than 10 super investors who have more than 10% of their portfolios invested in the company. Those are huge positions, including an 11% outright buy in the most recent quarter from Chris Hone. So far, that served him pretty well. With the widespread use of AI applications across its business, Microsoft today is the most valuable company in the world with a $3 trillion market cap, yet it still trades $30 below its 52-week highs. So this recent pullback has been broadly seen among these big tech giants. Even at today's lofty prices, Microsoft still pays shareholders a 0.74% dividend yield. This is something they've grown by 10% in the most recent year, and they've continued to grow their dividends for each of the last 19 years. Very likely, Microsoft will be a dividend aristocrat and then maybe even someday a dividend king. Overall, though, they do dilute shareholders, and so they have a 0.63% shareholder yield. In its history, Microsoft's probably the best performing stock of all time. Nobody seemed to tell that to Microsoft, though, as in the last decade, the company's up nearly 9 times alone. You may have to watch out that even though this is a very high quality, durable business, it's out above many of these standard methods of valuing the company, and there's a lot of growth and a lot of profitability being priced in here. That never seems to shake off analysts who today are still targeting a $484 price target, giving Microsoft a 21% upside. The big elephant in the room that we need to address is that Tesla was left off this list. Tesla's broadly using AI in autonomous driving, yet today there are no super investors who own the business. That may be a sign of something to chew on. Overall, what was the most surprising to you about these businesses? AI's been benefiting a lot of the largest incumbent tech companies, and it doesn't look like that's very likely to change, at least not right now. If you want to learn more about market opportunities, watch the next video and sign up for our investing tools linked in the description. You can make requests, track more than 55 stocks, and get exclusive bonus coverage. As always, thanks for watching.